Awesome. So, thank you so much, sir, first of all, for agreeing to talk to us and guiding us, helping us learn from you. Of course, you are a very, very famous personality and you're very, very experienced. So, this is honestly a fanboy moment for me to be able to talk to you and ask you questions that I want to know. First of all, a very thanks to you, sir.
No, my pleasure. Thanks for having me. Thank you.
Right. Sir, let's start with just the current market scenario right now. I personally follow you. I've been following you for quite some time. I think so far as I understand from your stand that this is a good correction that has come into the market, and this is a time when one can look forward to a good run ahead. But I would love to know your analysis of the market. What is going on right now, and what do you expect, and what should one do right now in this market?
Yeah, sure. So, great question to get started off. Maybe it just allows me to give a complete kind of overview. So, if you really ask me, in whatever 23 years that I've been associated with the asset management industry and the markets, I'm probably now seeing it for the fourth time that in India we are seeing significant corrections in the market, and all of it, largely can be attributed to reasons which are probably kind of outside our boundaries. So, for example, in 2008-9, we had a global financial crisis. Well, actually, 2001, when we had a tech, the tech bubble burst in the US. In complete empathy or sympathy, even our market collapsed. 2008-9, obviously, there was a global financial crisis. Again, started in the US, and again, in empathy, our market as well declined significantly. 2012-13, again, we heard of, tapering or withdrawal of quantitative easing. Then again, 2019, 2016 actually, there was a big commodity crash, slowdown in China, Mr. Trump's election, multiple reasons, and again in empathy, our market declined. And then 2020 COVID, our market also declined. But by the time when COVID, our market declined. Actually, we had barely 1,000 cases of COVID and single-digit fatalities. So that time also, I would put it this way: that while COVID was a concern for us also, the reality is that the panic started from Italy, Spain, UK, and then US, because that's where the cases were spreading. So long story short, in my 22, 23 years, I have seen multiple times that some or the other global concern, results in a big fall in our markets. But in each of these cases, eventually when the dust settles, it comes to the forefront that economically or from perspective of corporate performance, our market didn't actually do that. But the market fell purely because fund flows are correlated. So, the thing to look at it is that corporate performance or economic performance, which we measure by way of GDP growth, corporate performance, which we measure by way of, cash flow growth, earnings growth, etc., that is not as correlated as the fund flows are correlated. So I think, right now is again one such moment where our markets are falling in empathy with rest of the world, or maybe primarily in empathy with the US. So if you recount all these past examples, what you will learn is that whenever our market shows a sharp decline because of reasons which are outside of our borders, those have in the past always turned out to be great opportunities for us to enter. So that's how I'm reading it. And I don't think we should panic because of what is happening outside. It's not attributable in any significant manner to the domestic scenario. So that's where we are. And I think whatever is happening right now, without reading too much into it, we should figure out how we can take benefit of these opportunities.
Right. Awesome. Awesome. So thank you so much for sharing that. Sir, to continue on this trail, one of the biggest concerns that is raised around the world that people are panicking around is inflation in US, of course, but that you said kind of we are empathizing with the outside world. But in India also, inflation is kind of in concern right now, and RBI is also has been raising rates aggressively. Do you see that problem going forward, maybe?
Yeah, I mean, look, if you were to turn on an intelligent discussion, or if you were to read the newspapers, they'll almost make you believe that US inflation is our inflation, and a recessionary trend in US is going to result in a recessionary trend in India. And we are such nice people that we have really adopted their problems, and now we started believing that all their problems are also our problems. So when it comes to inflation, for instance, the point is that the causes for inflation in the US and the situation of inflation in the US is not nearly as comparable to whatever we have in India. That's the first point. I'll come to those reasons later. The second point is that 8% inflation in US would be very, very different from 8% inflation in India. And by the way, I'm sure everybody knows that in India, the official limit of tolerance of inflation itself is 6%. So, our targeted range is 4%. and 6% is officially our tolerance limit. So when your official tolerance is 6% and you have 7 or 8 or something, that's very different. Number one. Number two, construct of the economy, reasons for inflation, very different for us versus the US. So let's talk about US first. Uh, I don't know how to put this in English, but in Hindi, I can tell you that तेजी के बिना मंदी नहीं हो सकती है, right? So let's look at US first. Even COVID, post the global financial crisis, right from 2009-10 till 2020-20, the US was literally free. Okay, they probably enjoyed a massive bull run. Great growth, hardly any inflation. So by the time 2019 came, which is just pre-COVID, a gigantic economy like the US, $21 trillion GDP, was growing 3.5%, and they had literally zero unemployment. So the point is that even before COVID, they were witnessing strong demand, great growth, and they were literally flying. When COVID came, they added fuel to the fire, because when COVID came, you can check if relatives or friends in the US, literally everybody got thousands of dollars of credit in their account, even if they were not really needy people. They still got all that money. So they really, pumped up or defined demand even further. So COVID was basically, that they didn't have the kind of lockdowns that we had. So COVID was barely a 30 to 40 or 50-day episode for them. But still, they really played with fire by pumping the demand even further, by crediting thousands and thousands of dollars to people, even if they didn't need it. And even if they had their jobs and even if they were not in distress, everybody still received truckloads of money. Then on top of that, obviously supply chain disruption, and top of that, the war resulted in commodity prices really getting pushed up. So in US, any number of reasons you can enumerate for inflation to go up, all those reasons were literally present. Now you compare with India before COVID, we were 2.5 trillion economy. 21 trillion US grew at 3.5%. They had zero unemployment. They were literally flying, right? Like I said, India, what was India before COVID? For 10 years, our corporate EPS growth was low single digit. In dollar terms, it was 0 to negative. For 10 years, our stock market growth in dollar terms was literally zero. Okay. And before COVID, 2.5 trillion economy, we had 2% inflation and we had 3.7% GDP growth. Now, please understand that 2% inflation in India is as good as a recession. So the point is that why did we get inflation? We got inflation because of global reasons, which is that fuel prices went up, food prices went up, metals and commodities went up. All of that is correcting now. So the point is that the reasons for inflation in India are probably cyclical or transitory, or probably imported reasons. The reasons for US inflation in US are genuine homegrown reasons. They had excessive demand. They literally have been pumping money into people. In between Mr. Trump even cut taxes. Correct. So their inflation is not our inflation. 2% inflation in US is fantastic. 2% inflation in India is ghor mandi. 8% inflation in US is disaster. 8% inflation in India is just 2% above our official tolerance limit. And the third thing I'll tell you is, in my 23, 24 years, I have seen in India 9% growth with 9% inflation, which is disaster because some people become poor for no fault of theirs. I have also seen 4% growth with 2% inflation. It's in research, so everybody knows it was disaster. And in the best of times, I have seen 8% growth with 5% inflation. That probably has worked best for us. And it's theoretical to say that all inflation is bad inflation. If in a country like India, if you have 0 or 1% inflation, it basically means that some people don't have wage growth. You're not paying enough to your laborers. There is no inflation in food prices. There is no traction in prices. Basically, inflation can also give you good nominal growth. It can result in better traction for some parts of the economy. We are not America. We don't import everything, right? So I think it's absolutely wrong for us to kind of, it's good to empathize, not good to sympathize.
Right. Brilliantly put. So that's amazing to hear. This was such a clear, crystal answer, irrespective of what we hear around the world. So my next question to you is for people who are like me. So to be completely honest, I am myself very new to the markets and I'm not very experienced with the markets. I belong to what some may call the COVID generation of stock market, who entered the market for a great bull run at the right time. And
we have high hopes from you.
Right. So I do too. But for us, this is like first correction of life that we have seen, honestly speaking. So what advice would you have for people like me?
See, look, corrections are part and parcel, right? It's part and parcel of investing. I mean, that is what actually teaches you. That's the first thing. Second thing is that only if you invest, like, if you said you're a COVID generation, so you must have learned that if you invest amidst a depression, or if you invest amidst panic, you will make, ultimately good return. The second thing I can tell you is that if you take the last 30 years, okay, last 30 years of our history basically says that Our nominal GDP growth on a CAGR basis is 12.5%. Sensex earnings growth in 30 years on a CAGR basis is also close to 12%. And the rate of return on the Sensex, that is the price growth of Sensex over 30 years, is also on an average close to 12%. So the long range nominal GDP growth, long range earnings growth, and the long range index growth is basically 12% compounded. Now, simple question. If the long range average is 12%, how can you get more than 12% for your portfolio? There are only two ways to do it. Buy better companies than what is there in the index, or buy when the recent average is below 12. Only if you buy when the recent average is below 12 is that you will get on an average about 12. So what is the recent average? Last 1 year return is zero. Last 2 year returns is not comparable because your 2 year base level is so low, it was COVID. But last 1 year return is zero. Last 3 year return is also close to 11, 12. And last 5 year return is also close to 11, 12. So the point is these are decent times to invest and nothing to panic. Never panic just because foreigners are selling. We are not so important. No foreigner wakes up first thing in the morning and says India is a bad market, let me get out. We are just caught amidst the throes of a particular global situation right now. Not to read so much into it. Ultimately, dust settles, things will fly again.
Right. If I may ask, for a common retailer, if I may use the term small retailers, strategy, do you have a preferred strategy or investment philosophy that they should go for? If I may, like there are some who advocate for SIP, some who say or buy the dips, or they may be investing in growth companies or value investing. So there are so many strategies available. Do you have a preferred strategy?
You mean to say value or growth?
Both. So one is value versus growth investing. The other is SIP versus buy the dips. I somewhat see them relative in some ways.
Yeah, no. So see, buy the dip is, I think personally, if you ask me, is theoretical because you don't know exactly how deep the dip can get, right? So I think that just doing SIP, which is fairly dumb manner of just buying every fortnight or every month, I think that is better than trying to so-called buy the dip, because like I said, how deep will the dip get is anybody's guess. I don't think it's possible to time it to the T, right? So I would put it this way, that just doing a dumb SIP is ideal. Your other part was, value versus growth, and there's no end to it. Value, growth, cyclical, contrarian, blah, blah, blah. Stock doesn't know calling it. That's the simple thing to keep in mind. And at some level, every type of investing is value investing, because, you may use different metrics to define value. That's the point. But ultimately, all investing is value investing, because what are you doing? You are basically trying to buy it below intrinsic value, and then you're expecting that it should appreciate. But having said so, there is this notion that stocks which are showing good earnings traction and stocks which are trading above average PE multiples, supposedly called good, and stocks which are trading, at attractive, say, PE price to book, dividend yield, etc., or stocks which would fall in some kind of contrarian bucket, people call it value. Now, look, at White Oak, for example, in my firm, for instance, we don't believe in classifying anything as growth, value, defensive, cyclical, etc., etc. Basically, what we look at is that, when macros change, styles go in and out of favor. So let me elaborate on that. Basically, if you look at our market from 2015 to 2018, interest rates were low, liquidity was benign, oil prices were in control, commodity prices were also soft. And in general, everything to do with domestic cyclicals and so-called growth orientation did very, very well. So that would be called great stock picking, great performance. But at the end of 2018, oil went to $88, and a particular financial institution called ILFS, they defaulted on their debt. So there was a credit crisis. So all those, benign liquidity conditions, etc., everything went out of the window. So 2015 to 18, domestic cyclicals did perfectly well. And one would say that, I'm a great stock picker and my portfolio is doing well, blah, blah. But for no fault of that particular manager, when ILFS defaulted and oil price went to 88, all that domestic cyclical and growth orientation went out of the window. And IT and pharma, which were hated sectors, in 2019 and 20, they became the best performing sectors. Now, 2019 and 20, IT and pharma were the best performers. But in 2021 22, it's been cyclicals. Public sector enterprises, oil, metal, commodities, a lot of stuff which you would associate with low governance, all of those things have been flying. So the learning is that when macros change, styles go in and out of favor, sectors go in and out of favor, and market cap segments of the market also go in and out of favor. So the best position is to have a balanced portfolio and ab initio, not to bucket yourself as growth, value, defensive, cyclical, large cap, small cap, because all of those things will kind of put you in some narrow crevice or corner of the market. And when macros change, segments of the market go in and out of favor. If you want to sustainably outperform the benchmark, it's best that you have a balanced portfolio. You're neutral to growth value, you're neutral to defensive cyclical, and you are well allocated across large, mid, and small cap, that is the best way to beat the benchmark consistently. Ab initio, if you slot yourself in particular corners or crevices of the market, what will happen is that the more you deviate from the benchmark, the more the scope for outperformance, but also more the risk of cyclically underperformance. So we don't slot ourselves in any manner. We actually believe in running a portfolio which is diversified and balanced across all of what I described to you.
Right. Perfect, sir. That's so brilliantly put. In fact, you answered my next question before me even asking it. So my question, the reason I asked this was, what I understand from my limited understanding is, up until like what I saw in the bull run, a lot of people were running after growth companies and doing maybe SIPs in the growth companies. And now there is a chatter about buying good companies at with value in the dip. And so there's the winds are changing kind of like probably like you said the track the macros, and then when they change, the size come in and go out.
Yeah, so you will not be able to forecast in advance that oil will go up or oil will go down. Like I'll give you a simple example. Lots of people today would be sitting pretty, thinking that what a great stock picker I am. Look, I have a portfolio full of public sector enterprises, and last 1.5 years they have rewarded me so well. Now the point is that a year back, a lot of people were very happy to buy public sector enterprises because the government said that forget disinvestment, forget disinvesting, we will actually privatize. So people loaded up on PSUs thinking they will do very well. The government didn't privatize anything. They just sold Air India and they sold 5% stake in LIC. There was no other privatization. But what happened? Ultimately, there was a war. Oil commodities went up, and most of those sectors are populated by public sector enterprises. So you bought thinking something, and you are successful for some absolutely a different reason which you could have never forecasted. So forecasting macros is like a coin toss. You can only try to balance out the macros. You can only try to run neutral to the macros, but you cannot forecast. Macros are a source of risk actually. Like I gave you that example, that 2015 to 18, if you're a domestic cyclical growth oriented investor, you would have done very, very well. But in 2018, I narrated to you, a couple of macros changed and a perfectly good bottom up portfolio went out of balance because the macros changed. So macros are a source of risk. You cannot forecast them. Only thing you can do is you can balance your portfolio such that it is unaffected or as far as possible unaffected by the change of macros.
Right. Perfect, sir. So this leads to my kind of the next question that I have. One is, of course, having a balanced portfolio is the right approach, and we also saw the way that you believe in about to invest. Another very significant aspect of the current market, this correction, is managing your risk and stop losses and exit strategy in general. So, what advice would you have on that, sir, for us?
So, exit strategy is a valid question. In fact, most professional fund managers or most wealth managers or investment advisors, there is this perpetual insinuation or perpetual, allegation that nobody tells you when to redeem. So I think exit strategy is absolutely necessary for all the people. We also get blamed for not telling people when to get out. But the point is that, everybody has a different asset allocation. Let's say, for example, if I were to come on a OPI and say that market is expensive, please get out. I think that advice also would not sit well for a simple reason that the people who are listening to me, out of their 100 rupees, I don't know whether they have 1 rupee in equity, 10 rupees in equity, 50 rupees in equity, or the entire 100 rupees in equity. So generally, we should not be giving this kind of advice out in the public. But on the other hand, your question definitely rings a bell from the perspective that every investor should have their own exit strategy. And according to me, like I said, if the long period average for the market is 12% and long period average for, let us say, some mutual funds or some portfolios is say 14-15%, I think anytime you get more than 1.5 of the average, that means you're really don't attribute to your individual brilliance, don't attribute it to the brilliance of the fund manager. Basically, when you're getting way above past averages, it's better that you take some money off the table and put it into a safer asset class. And every time you are way below the average, then beg, borrow, steal, make sure that you allocate more to equities. So I think everybody needs an exit strategy. There is no scientific answer to it. The answers are all rooted in personal asset allocation. They are all rooted in personal ability to tolerate risk. For example, I always stay invested in equity, and 20-30% decline in my portfolio doesn't make me sleep. But I can't assume that everybody is in the same bracket. So I would put it this way, that every investor should know their tolerance. Every investor should know what will make them lose sleep. Every investor should know what will make them react emotionally. So exit strategy is important. And like I said, a good rule of thumb is that when you're making way above average, don't attribute it to your intelligence or the fund manager's intelligence. If you're making way above average, take some money off the table. If you're making way below average, add some money. I think that is very important. Uh, yeah, so that's on exit strategy. But I think that, again, it's very personal to each individual's asset allocation, and it's very personal to each individual's ability to tolerate risk.
Brilliant, sir. Thank you so much for sharing that with us. Okay, so sir, since we have some limited time with us with you, so can I go into a rapid fire mode and get to know you a little bit better?
Yeah, sure. I'll try to answer what best I can. Yeah, please.
Awesome. So these questions may seem a little odd, but all right. So I'll go with it. So if one were to gift you a stock on your birthday, which stock should it be, or maybe index or something, anything?
So there is a double negative in your question. Number one, I am not allowed to invest in stocks, so then I should not be
Yes.
accepting stocks. And number two, I am not allowed to accept gifts. So short of me accepting a gift and no question of me owning a stock. I invest in all the, it's mandatory for me to invest in the funds or the portfolios which are managed by my company. That's a principle that one follows.
Okay.
So
So
yeah, I'm really sorry, I don't have an answer for that.
hypothetically speaking, if you were allowed to have, then maybe.
I hope White Oak gets listed. That's the stock to own. But other than that, I really don't have an answer for you.
Awesome. Awesome answer, sir. Okay. Next is your favorite investor or trader you really look up to, maybe, or were inspired by historically or present or anywhere.
So there are many people that I see. I don't have any role model or I don't have any guru, but I like to read a lot. Okay, and if you really ask me, let us say so, it would be more the authors who have influenced me rather than the traders or the gurus. So, for instance, if you ask me, in the last few years, there is a reason why the Nobel Prize in Economics has been given to people who study human behavior. Correct. So, from that perspective, guys like Dan Ariely, Richard Thaler, these are the guys to really follow, or say Robert Cialdini, who wrote that book called Influence. So these are the guys, they are the guys who have influenced investors. So I think if I were to go back to the source, then I would say, people who have written these books, or for example, two more. Like there is a gentleman called, there is a author called Phil Rosenzweig, who wrote this book called The Halo Effect, which is a book on strategy. Or there is, say, for example, this book called Investing, The Last Liberal Art, right? So people who have written these books, like that was actually Roger Hackstrom. So people who have written these books, people who are thought leaders, I think I would say they are bigger influencers. And even if you were to read, like my ex-boss, Mr. Ramdev Agarwal, or if you were to talk about Mr. Buffett, or if you were to talk about Mr. Munger, they will also tell you that they're influenced by the people who are thought leaders rather than the people who are portfolio managers or traders. Really.
Absolutely brilliant, sir. Thank you so much for sharing that. Okay, so sir, if I may ask, what was your first trade ever? Like, which stock did you buy personally for the first time when you bought in your life into stock markets?
So that was so I don't invest in stocks like I told you, but yes, in a past life, I was not when I was not a key management personnel in an asset management company. So I'm talking to you about late 90s, when there was a tech bubble. So
Yeah.
one of my seniors in college told me to buy this company called Mascot Systems. I really don't know what happened. So I have not had too many experiences buying stocks. I've been investing in portfolio management services or mutual funds, whatever is run by my company. That
Right.
is what I invest in. I would just like to clarify that I was not brilliant. I didn't buy Mustang. It was Mascot, just clarifying again. And I really
Okay.
don't know where it is now. But I generally don't buy stocks. I mean, I sit in some investment committees. I follow what our team does, but I personally don't buy stocks.
Okay. 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 Next one, sir, is what was probably maybe the most expensive mistake that you made in the stock market, or the biggest learning that you got in the market or some opportunity that you missed, anything that you regret or had a great learning from?
See, by nature, I'm not someone who regrets anything. So that is more a personal, mental makeup kind of thing. I'm not trying to say there is anything great about it. But generally speaking, I don't regret anything. But yes, when you mentioned about learnings, I think, I think the biggest learnings are always made in the crises. Like COVID, for example, was a crisis. And what I've learned is that human beings, there is a very famous author called Rory Sutherland. Rory Sutherland was I really don't know his exact designation, but very, very senior creative person with Ogilvy. Right? He's written books like Alchemy, very famous book.
Yeah. Yeah.
So he said that human beings are not logical, they are psychological. And I also mentioned to you that the reason why the Nobel Prize in economics goes to people who study behavior rather than the people who study currency and exchange rates and interest rates and demand and supply. Correct. So that should tell you that, like for example, whenever there is a crisis, and I consider myself lucky that, last 20 to 23 years, I have consistently been meeting, speaking to, like in any given week, I might be addressing or speaking to 3, 4, 500 investors uh, religiously pretty much every week. Either they are one-on-ones or they are meetings or they are meetings in a large banquet or something like that. So privileged position because I get to interact with investors a lot, and at any point in time, I do get a kind of peek into what they are thinking. So since you are asking me what are my learnings, I think when there is a crisis, a lot of fund managers and a lot of industry professionals, they throw a lot of numbers and a lot of science and a lot of logic. That's why I said human beings are psychological, they're not logical. So what people actually need is handholding. They don't need numbers to be thrown at them. If you impart belief, if you impart conviction, I think that is ultimately what matters. So for example, in May 2020, when the market collapsed, small and mid caps collapsed by about 60%. Correct. So talking to investors and seeing their emotional reaction when they lose 40-50% of the money off on paper. If you stay put, you don't lose any money eventually. But seeing emotional reactions and seeing how people react to emotional stress, seeing how people react to money being 20, 30, 40% down, I think that gives you the biggest learnings about how individuals think and how they react to circumstances. So all the big learnings are always in the crisis, if you really ask me.
That's brilliantly put, sir. Thank you so much for sharing that, sir. Okay, my next question, sir, is so of course we discussed about the some of the biggest learnings you got. Next one is, what is maybe one thing that you are really proud of that you did in the stock? It may be identifying an opportunity at the right moment, or a great trade that you did, or anything that you're really proud of in the stock markets.
See, I don't think I should be proud of anything that I have done at all. I don't think there is anything like that. But I can tell you one thing that by my mental makeup, I am not a pessimist. Like generally, I don't believe that human beings are the next dinosaur, and I think that is what is most required for you to survive in tough conditions. When people swing to the extreme, see, stock markets are known. Stock markets are known for making people think. In my 23 years, there have been 4 instances where people tried to tell me that the world will come to an end, but it didn't come to an end, and here we are. And when things are booming, people make you believe that all the trees will grow to the sky. So I think having a balanced mental makeup, being marginally an optimist, I think these are things which are important. And this is what I have learned. I don't think there is anything to be really, really um, proud of. Yeah, I mean, learnings are important. That's how I would put it.
That's so humble of you, sir. Thank you so much for sharing that, sir, with us. Okay, so I have a lot of questions, but I had pinned a tweet in the in this space, and we have got some questions on that tweet as well, sir. So I'll give them priority. So,
Sure.
sir, Srinivas sir ka question hai, which sectors in the next 7 to 10 years would be the biggest wealth creators in India as we move from 3 trillion to 6 trillion economy? So do you have a view on the sectoral view on longer term horizon, maybe?
See, I think you can talk all the esoteric things, but people ultimately want to know kal subah kya linega. I'm not into that, frankly, but yes, I can tell you 2 or 3 things. First is that, look, the biggest problem with the world today is that the countries which contribute the most to the economic output in any incremental output in any given year. So countries which contribute most to the world economic growth and countries which are the richest countries in the world, the problem with this part of the world is that they all are aging. Okay. So whether it is Europe, China, Japan, South Korea, of these countries, it is irreversible. They are aging. All of them don't have young population like India or Africa, and all of them don't even have great immigration policies. And to top it all, great universities and technological innovation like the type which the US has. So the point is that we are now suddenly finding ourselves at a stage where you will find that more and more people, more and more, and obviously the world is run by corporates, and corporates want growth, and most importantly, growth is material only if it comes at scale. So now, how many countries are there in the world which can give you growth at scale? And moreover, this GDP and all is basically population into productivity. That's what gives you growth. So we have population. We are attracting investment because people think that they can help us bump up our productivity, and we can afford growth at scale. So if you ask Mr. Buffett that, what is the secret sauce of his success? He is a humble guy. He always says that I was born in the 30s and I started investing in the 50s and 60s in the US. So I was lucky. And, Mr. Buffett would not be Mr. Buffett if he was born in Kenya or Bangladesh. So all the people on this Twitter spaces, same applies to them, that they should be thankful that they're in the right place at the right time. Because just when India's couple of decades are starting, just when the world pretty much doesn't have too many choices, is when you are actually investing in India's stock market. So first and most important, just make sure you're on the right train. Don't worry too much about the bogie and the seat. That is the most important. You should be thankful that you're on the right train in the first place. But of course, the question is on sectors. So I would say everything to do with banks, the big banks. The big banks, I think, because generally I read somewhere that when an economy, this thing about 3 trillion to 6 trillion. So the point is that if the economy goes from $2,000 per capita to say 3,700, 3,800, $4,000 per capita, then what gets maximum traction is basically credit offtake, consumer durables. These are the kind of things. So frankly, I don't believe in forecasting macros, but what I'm talking to you right now is not really macro. It's just basics, right? That's what we are seeing right now. So I don't know, kal sube kya lega, I don't know. But since the question was on sectors, I thought, banks which are purveyors of credit, the big ones actually, because the big ones benefit the most because, they have highest CASA balances. And if credit picks up, then I think they are the ones which will make the maximum margins. And banks bigger is better because, maybe they are more safer, more sturdier, better processes, less cyclicality, etc., etc. So I think banks is there, consumer durables, IT enabled services, digital, all of those. Yeah, so can't make an exhaustive list, but I've just given you some examples.
Right. Perfect, sir. Thank you so much for sharing that. Of course, whatever we discuss in this space is none of that is a buy or sell recommendation whatsoever. So just there's a disclaimer around that. But yeah. So next question is by Mr. Slickback, and he wants to know your opinion on war stocks and whether it's something to go for during this Russia-Ukraine crisis.
Sorry, what's the name you mentioned? Slick something?
Mr. Slickback is his handle, and it says Hugh MF Freeman is his handle.
Okay, sure. Yeah, I mean, on Twitter, it's a bit odd, right? I mean, you can look me up, look my biodata, you can look everything, but I answer something which I don't know. But yeah, anyway, I think I don't believe in investing in based on these kind of themes because I don't think anybody could have predicted the war. So I'm quite sure nobody can predict when the war will end, right? So humble suggestion: don't invest based on themes. Themes can just run out of favor quite quickly. So better to do bottom up. And all these themes and macros, like I mentioned, they're a source of risk. They can't be a source of return. So balance the macros, but invest bottom up. That's what I would say. Right now war is top of mind because Germany said they'll spend $100 billion and all those kinds of things. Uh, so that obviously catches a lot of attention. I do not take, I'm not taking all these geopolitical changes and the change in the world order. I'm not saying anything of that should be taken lightly. Don't misunderstand me. But the point is, I don't think you can make money from it.
Right. Thank you so much for sharing that, sir. Okay, next question, sir. Preetham Kumar Rahul sir ka aaya hai, and he wants to know if do you feel inflation has peaked out? We heard from the markets. The next 2-3 quarters are going to be tough. What's your take on it? So I think we already kind of covered that in the spaces. Preetham sir, we'll release a recording of the spaces, and you can hear it maybe towards the starting of the space. Sachin Dubey sir has asked then, do you think the participation of retail investors in the stock market will keep increasing over the coming years, considering the small percentage of such participants? And secondly, do you think they will have the patience to go through the bear market levels like the past 8 months?
Yeah, so second one is easier to answer. Basic point is those who have patience will make money. Those who don't have patience will lose money. Frankly, you and me definitely cannot forecast whether people will lose patience or not. But I think by and large, there is a process of maturing. And at any point in time, there are different cohorts of investors. So what happens is that in reality, if you ask me number of Demat accounts and number of investors, and maybe that got attention during COVID. But it's wrong to say that the number of investors and the number of retail participation went up only post-COVID. I think that's a wrong assessment. In reality, if you track the data, the rate of growth was not as much as COVID or post-COVID, but there was fair amount of growth post-demonetization actually, because that's where the first real stroke of formalization and the forced adaptation of digital technology and the forced adaptation of digital money or putting money into the bank, etc., and a big drop in interest rates with high liquidity. All of that happened post demonetization. So the real capital market adaptation started post demonetization, is how I would put it. But the point is that it's here to stay. So there are a lot of people who came in 2017 And for them, the experience in the market is that 2020 scared the daylights out of them. So people who came in 2017, 18, for some time they may have thought that this market is just not for me. And people who came in 2020 might have thought, what is all this song and dance about? It's so easy to make money. The point is that it's not as difficult as it appears to the guys who came in 2017, 18, and it's also not as easy as it appears to the guy who came in 2020. It's always, the answer is always in between. The other part was about capital market adaptation and number of retail participation. It is bound to increase because in English there is a proverb which says habits change with generations. And in last 20 years in India, not only digital adoption, not only formalization of the economy, what has changed the most is that there is a big structural drop in interest rates. When I started my career, people had no reason to put money in equity and equity mutual funds because for example, the RBI used to issue bonds on behalf of the government of India. They were called RBI, they were called relief bonds. That used to give 11% tax free, and obviously it was risk free. The post office used to give 10% for monthly interest schemes. I think, if I'm not wrong, SBI deposit rate was 10%. I think PPF was 12%. So there was a point in time in our country, and unofficially interest rates were 2% per month in cash. So there was a point in time in our country where it just didn't make sense to take a risk. There was no reason to put money in the capital market. But in last 20 years, that has changed dramatically. And I think now there is every reason for people to approach the capital market because there is nothing called fixed interest rate. There is less and less of what is called parallel economy. Capital market and digital adoption, that's the way to go forward. So there will always be periods of good return and bad return. There will always be phases when investors are happy or unhappy. But I think digital adoption and capital market adoption is here to stay. I think it's a irreversible process, more so given the demographics.
Right. Brilliantly put. So this has been an amazing session. Of course, the kind of knowledge and wisdom you imparted with your years of experience, and to add to that, you have a certain way of frankness, maybe it is, that makes it just so fun to listen to you. I can go on for hours and hours just listening to you about stock markets and asking my questions and the barrage of questions we have received on this tweet. But of course, we have a hard stop on time. So just one last question, if I may ask you, is
Sure.
one quick concluding remark or some advice that you would have for our listeners and me tonight, sir?
See, I would just repeat what I said in the beginning, and I'll put it in a different way. In spirituality, we are taught that all answers lie within. So, if you have any questions or if there is any conundrum in your life, you are taught that, look within. All the answers lie within you. Don't apply that logic to the stock market. Every time the market falls, the reasons are not necessarily within our borders or within our markets. Markets can fall for a myriad set of reasons. You just have to see that something which you were in love with when the index was 18,000, are you in love with it when the index is 15,000? I think that's what you need to look for. So I have, like I said in the beginning, in my 23 years, I have seen at least 4 or 5 times our market crashing big time because of global reasons. By the way, everybody's focused on FPI flows. Let me tell you one thing. If you take 12-month rolling data of FPI flows, what you will find is that whether India has done well or India has done badly, on an average, FPI flow is $5 to $10 billion positive year on year in India. Only when there are global issues is when it suddenly turns big time negative. When the dust settles, it suddenly turns big time positive. So right now we are big time negative. If the dust settles, you will not find the market where it is. So let's not get preoccupied. Let's not empathize and sympathize too much with what is happening globally. Basically, for global reasons, our market becomes cheaper. Then we have to think whether we want to capitalize from the opportunity or we want to, really. Like a lot of people tell me that no, let's wait for things to stabilize. Well, yes, absolutely right. If things stabilize, you'll not find the market where it is. So it's a question of whether you live in the past or you live in the moment. I think very important to live in the moment and take benefit from what is happening.
That's brilliantly put, sir. Once again, I sincerely say that I cannot thank you enough for taking out time for us and imparting your learnings with us. This has been an amazingly awesome session, sir. And of course, our listeners as well. Thank you so much for listening to us for
Thank you.
throughout this
Thanks for
hour.
having me.
Thank you so much, sir. All right, everybody. Thank you. That was me. Thank you so much for tuning in. See you soon. Have a profitable day and a really good night. Bye bye.